What's going on, everybody? Michael Silva here. You're watching the Daily Stock Market Brief, the show that we do Monday through Friday, 5 days a week. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. Before we hop into today's show, I want to do a couple housekeeping things. Number one, there is a spam account that keeps popping up. I get a lot of spam bots, so please just be on the lookout for them. Report them if you can. They look like me sometimes. They sometimes don't look like me, and just so you know, I'll never, ask for, Bitcoin or give you a WhatsApp number to call. So if you see that, that's not me. Obviously, most people know that, but I just want everyone to stay safe out there and not be persuaded by these spammers. The next thing is, if you follow me on Instagram or even TikTok, both my accounts got banned, I think. I can't access my Instagram account, so I can't even see that. I can access my TikTok account, but for some reason, I'm unable to get my new videos to post there. So I'm working through that pretty much nonstop this last week, trying to figure out what the heck is going on. So we'll see what goes on with that, but I just want to give you the heads up there. Let's go ahead and get into today's episode. We do got some interesting things developed, and I can't wait to get into it. All right, welcome back. We're going to start off here with the dashboard. Happy 420, everybody. Dogecoin hit 420 and then took a dump. We're looking at the market dashboard. Look at what's taking the lead. Utilities, and we see real estate and consumer staples up there. We talked about utilities taking the lead here, and to be cautious when utilities start getting a little bit more strength, as well as consumer staples, just because of the fact that when we see those typically start seeing strength, it's more of a defensive move in the markets. And you can see here, obviously to the left, all the markets are down on the day. Nothing too crazy, nothing amazingly dramatic. We had small caps down 2.33%, so that's a pretty big hit there. But we'll get into these individual indices and charts. The timestamps will be in the description below. I want to go ahead and call out our lagging sector here, energy, because energy has been one that I've been really keeping my eye on. Like I said previously in other episodes, I got out of my energy position with a very, very small gain. But I wanted to call out here from a relative performance, we are back below this 20-day moving average, and we're kind of just cruising lower here. And I pointed out on a previous episode, this could be the left shoulder ahead and a right shoulder building out. So the neckline would be right above this 0.14 from a relative standpoint. Now from a absolute standpoint, where we're looking at the XLE, I'm looking at right around 45 for potential opportunity for going long. And the reason why is because it acts as resistance not only once, twice, but 3 times. And when resistance is broken, we saw it really move up, and now we're seeing it pull back down. So resistance, when broken, it can become a level of support. So that does make sense to me. If we do get down there, it could be an opportunity to go long. So I'll be keeping an eye on that, as well as the chart of oil, which I will be talking about in the commodities section of this video. Let's hop into the indices, starting with the S&P 500. First thing I'm going to call out, yes, we had a down day. What I want you guys to pay attention to now is that we closed below the 5 EMA, and it has been quite some time since we've done that. April has been just a vertical move to the upside. We ran into resistance, and now we are below the 5 EMA, so the bears have a little bit of control there. But typically when we get down there, it doesn't stay down there for too long. So I would say, immediate downside would be right around 4,050, where that gap is, and the 20-day moving average. So we'll see here what plays out. As far as like any sort of trade positions, we'll go into the SPY, more intraday stuff, 30-minute time frame, a little positive divergence there. We did break down. Maybe we get a retest and then head lower. I'd say the immediate downside is right around 406 to 408. If we do get a complete breakdown of this, broadening wedge type pattern here, I'd say 398 to around 404 would be a potential buy zone if you are trying to buy that specific dip. But as I see it right now, we need more time to unfold. There can definitely be more downside as we've seen in the seasonality chart, where the middle of April to end of April, you get somewhat of a pullback, but then you typically get another ramp up too as well. So we'll keep an eye out for all of that. Nasdaq did cross below the 5 EMA as well. So now this is an area of resistance. If we continue this rollover, We have one more gap below us here, and then we have this gap in the 50-day moving average. So this right down here around 320 to 325 could be a very good area of confluence. So if you're looking for long setups, let's start thinking about that. If we start rolling down, we can start looking for some long setups right around this range. And at the end of this episode, in the conclusion section, I'm going to be talking about a technology stock that I posted on Twitter earlier and kind of why my eye is on it, because it does seem like a good setup here. Now, here's the cues on the 30-minute time frame. This does kind of look somewhat of a topping type pattern right here, but we do have a little bit of a positive divergence. You see some strength coming in at the end of the day. We'll see what the overnight session brings us. But if we do cross below this 334, 332 to 334 zone right there, I think the immediate downside would be right around to 326. We do have a lot of gaps below us, so the selling these last 2 days, yeah, we've had a little bit of a pullback, but I mean, we had 13 straight green candles in a row. So I think it's okay to see a couple small little red candles. So nothing too, technical, like structure wise has been broken as of right now, but we'll keep an eye on it, right? Here's the semiconductors. If you're looking for a good semiconductor setup, look, we broke out of this kind of trend line right here, and we saw this big move to the upside. And now this is really, crossing not only below the 5 EMA, but below the 20 SMA too as well. So I think that this 3,000, so 2,950 to 3,050 range right here is a good area of confluence, right? We have the previous support can become, or resistance can become support, and then we have the lower Bollinger Band right there too. So if you're looking for a good semiconductor setup or individual stocks in the semiconductor sector, I'd say start keeping an eye on the SOX, which is the semiconductor index, and it could come potentially right down into this range, and then you can set yourself up for success in individual stocks. Here's the Dow Jones. Dow Jones did cross also below the 5 EMA, so the bears have a little bit of control here, but bears have control in a very, very bullish environment. So it's not saying much. Once again, right, the 20 sloping up, 50 sloping up, 200 sloping up. Everything's very, very bullish here, and the last couple of days of selling weren't all that powerful. So, let's just keep an eye on it, see how it goes. As it stands right now, where would I look at for an area of support? I would say right around 3,500 as of right now, because that's the closest moving average right down to the downside. So that's where my eyes would be at. Until then, we'll just keep this, keep an eye on it here, projecting as the days go forward. The transport's important to keep an eye on too. Did see a pretty significant move in volume, which is interesting. We had a gap up, but then we closed, was a lot more bearish. We closed right on the 5 EMA. So, pay attention to this, because if we start getting below the 20-day moving average, then that could send us potentially even as low as the lower Bollinger Band, right around 14,200s. And we know how the industrials, in order for them to perform, we also need the transports to support it, and vice versa here. So this does look like just a period of consolidation. So perhaps we're getting consolidation, getting ready for another break out to the upside, which is always a possibility. So we got to be mindful of that as well. Russell 2000 was the weakest performer, right down 2% here on the Russell 2000. This is the IWM, the ETF. Now, this is important to know, because what I'm looking for right now, if you haven't caught my theme of today's show, is looking for specific areas to pull back. Why do I think that? Well, I don't necessarily think that the top of the market's in at this particular point in time, and I'm looking for opportunities to potentially hedge along, good areas to pull back to. So now the market top could be in, right? Who knows? But given the current environment, it's more probable that we'll see the market continue to ramp up than to see it completely roll over. And given the last couple of days, the selling hasn't been so dramatic. So what I'm looking for here is areas of support to potentially go long into, and then, see how it plays out from there. So yeah, things have been getting very overextended. It makes sense that we can see somewhat of a pullback, right? Pretty simple here. Well, the IWM has been kind of this topping pattern right here. A lot of people are saying, this is a head and shoulder pattern. Okay, I can understand that, because I can see the left shoulder, the head, and the right shoulder building out, and I can see it as a topping pattern. It's closed below the 50-day. The 20 is crossed below the 50. It's below the 5 moving averages, right? So it looks pretty bearish here. However, what I want to call out is this neckline right here is right around 210. So if we come down to 210, that actually could be potentially a good buying opportunity. And let me explain why. First off, from a risk versus reward standpoint, you can have a very tight stop loss, and it'd be very easy to manage that trade from a risk perspective. And every time we've landed there, we've seen some pretty big run-ups from that level. Now, when I bring up the monthly time frame, right? We broke out of this channel, and I've been talking about this potentially being exhaustion break, which means it breaks up and then it breaks right back down on higher volume. So that's still a very big possibility. But what I want to call out here is it broke out of this channel, which you have to consider it bullish to begin with, right? You got to give bulls the benefit of the doubt here. So this is an area of support. Yes, it is very overextended. I know this, okay? And what I want to call out, though, is the 5 EMA is right at 210. And the 5 EMA can act as a level of support. It has previously. So if we do get this continued pullback to 10, only like from this monthly perspective, which is the monthly 5 EMA reconnect, and then also this neckline perspective, makes sense that could be a good area of support. Hence why I believe it's a good risk versus reward trade going long, because it's very easy to manage the risk to the downside. You could literally have an entry at 210 and some change, and then you can have a stop loss literally right below it. If you get stopped out, okay, so you lose $1 per share on the trade. Big deal, right? It makes sense from a risk versus reward standpoint to me. Here is the stock market indicator section. This is where we have the interesting developments that I want to talk about. All right, so here is the lumber to gold ratio. This is some interesting things that are developing. We do now see lumber, which I'll get into that in the commodity section. We have gold that's outperforming lumber. So what we saw here was a pretty significant move to the downside. Now it's still above zero, so that means risk on, right? When it crosses below zero, that's risk off. What does that mean? It means that the conditions for a potential market to have some increased volatility are greater than usual. It doesn't mean that a crash is going to happen, but this indicator has been very accurate in predicting and getting ahead of the curve when it comes to big market collapses. Now, this is part of Michael Gayad's award-winning research white paper. So if you haven't seen that, you can go read that lumber to gold paper. I did interview him here on the channel, and he talked more in depth about it as well. But you can see when it crossed below zero here, the market rolled itself over during the pandemic. When it crossed below zero here, we did see that moment of volatility in October there, that big kind of downdraft. And now we haven't really been below zero for quite some time. But now, lumber's been on this monster tear to the upside, and today we actually saw a pretty significant down day, which I'll bring up here soon. Here is the XLU to SPY, another indicator that Michael Gayad uses from another award-winning research paper from the beta rotation strategy. This is still actually above zero, which does mean risk off. So this does signify that there is still a possibility for increased volatility. So we got to keep an eye out for that. Now let's go ahead and look at the fear index. We're looking at the VIX right here. We did break out of this rising wedge, and we did close that gap just immediately above us. The upper Bollinger Band can act as an area of resistance. So 20 to 21 could be a potential area to keep an eye out for. If we do, that can act as resistance, which means that we might see the market move down a little bit, but if it comes into this range, we might get rejected, which means the market could head up a little bit higher from there. So we got to just be mindful of that. And we could look at this at lower time frames, like the 30-minute time frame, and you can see here we did create a gap today to the downside, so we got to be mindful of that. But we do still have two gaps above us from 24 to around 26. So be mindful of these gaps, and gaps in the VIX, they do typically get filled, as we filled one today, and we filled finally. It took a year to fill it, but that gap from a year ago, that was right up around here, that started the pandemic. Now we do still have one that hasn't been filled from February, and that is still below us, so we've got to be mindful of that down there as well. From the breadth perspective, negative divergence still. We saw a spike down of minus 28. That's not really an overextended reading to the downside. If it gets more down to minus 60 to minus 80, we've seen bounces in the market from those areas. So we'll keep an eye on that. If we do get an overextended reading to the downside, that could present an opportunity to hedge long in certain trades. Now let's look at commodities. First off, lumber. We talked about that already. Big day in volume here. We had a gap up, and we rolled itself over. So on a negative divergence, could this mean that we might see more downwards movement to come in lumber? Perhaps. I mean, this thing has been completely parabolic, completely vertical. It's just absolutely crazy. Now, if gold continues to outperform lumber, that's going to drive that rate of change more towards that zero. And you got to understand, when lumber is performing, the certain markets do very, very well. And all of a sudden, if gold starts performing, that's that whole safety trade. That's fears coming into the market. So we watch that rate of change take place. And you can learn more, like I said, on Michael Gayad's white paper there. Now, when I look at gold, Gold is just in this perfect kind of bear channel right here, but it's overall on a bull flag. 61.8% retracement level did hold as support. Now we're kind of just sitting here at this area of resistance. Not the greatest looking candle on the week so far, but we do have time to go. This is the weekly time frame. From a daily perspective, we're still holding strong. Okay, so we're still doing good around here. And what's funny is one of the tweets, Keith McCall from Hedgeye, I don't know if I'm pronouncing his last name right, but he's been super bearish on gold, and he's been pretty accurate in shorting the market. But today's tweet, he was like, talking about shorting the market or going short here, but then he said something that was like not as confident as his other shorts. It was like, well, if it continues to head up, then basically it's a bad trade. So adding the whole if in there was kind of weird because he's been super, super confident about all of his trades. And now it's kind of like he's leaving a little bit of a door there, a little open door to be able to say, well, it did look like it could potentially go higher. So I found that to be kind of interesting. But overall, I mean, gold has been building a base out here. It is looking stronger. And significantly stronger than we saw from this peak and this peak, where it was just a gigantic move to the upside and then rolled over. This right here does not look like it did over here or over here from good areas of shorting. This is building a slow base and is building up higher lows right here. So keep an eye out because this could be the early start. And if you didn't watch my video that I recently posted about gold, go watch it because I talk about the nominal interest rate and the real interest rate and where they kind of are at and why I believe that we are starting kind of this bull trend here in gold. Now, that doesn't mean that it's going to go parabolic right here. It means that this is the accumulation phase where we could see it start heading higher, in the months to come. Now let's look at silver. Silver is looking a little exhausted here coming into the 50-day moving average. Maybe it's taking a little bit of a break, consolidating to head higher. It did right here, broke out, flagged out a little bit, then headed higher. Now it's doing the same thing. Let's keep an eye on it because this to me says, it's not the greatest opportunity to go long right here. And it's not the greatest opportunity to short it right here. I still think we have an immediate downside back down to that 200-day moving average, which is right around 25. And then I think we can even head as low as 24.50 very quickly. So we'll keep an eye out. If it breaks above 26.50 and it can get above that kind of range right here, 26.50 to 27, I think that would be setting ourselves up for a very, very good move to the upside in silver, but we're not quite there yet. GDXJ is the miners. I want to keep a close eye on these. This is the weekly time frame. Huge bull flag forming. Price percent oscillator did cross over to be a bullish crossover, but it is still below zero. Look for a confirmed break on a weekly close above the 50-day moving average and this resistance, and be very careful for a false breakout. But if we do get a breakout of this, I mean, we're talking a full measured move would bring us up to probably around a 90% gain. It would take a while to get there, most likely. It hasn't in the past on these big flags, but just be mindful that, we're still early in this trade right here. I'm not in the trade right now, but I'm just kind of waiting. So it's at the early stages. So don't feel like you need to just jump in because this can easily act as resistance and then head back down to 40. So that's still a very strong possibility. So make sure that when it comes to managing risk and kind of setting yourself up for success, we want confirmed breakouts in this environment. Here's WTIC. This goes back to the whole energy trade. We did have this little false breakout of 64, and then we had, also it come down to the 50-day moving average and acted as support. So let's see here what happens. Is it going to continue to build up? And then that could present a good opportunity to go long XLE right at around 45 to 46. So we'll monitor that. That's a possibility. Or if 64 doesn't hold and it starts rolling back down, stay clear of certain energy stocks. Let's look at the dollar. Dollar found a little bit of support today by the 61.8% retracement level. So this is still a potential buying opportunity in my opinion. Overall though, bearish trend. So, it'd be swimming up a river on a bounce up and it would probably find resistance right around 38.2 retracement level, which is right at around 92 on the dollar. So let's just kind of continue to watch how this goes. Now, this has been working in inverse of the S&P 500. It moved down and it broke out here on the S&P 500. So if this goes up, chances are we might see more continued weakness here in the S&P 500. I still think around 4,000 to 4,050, makes sense to go pull back to for the S&P 500. It'd be a healthy pullback right there. And 3 to 4% pullback in the near time, that makes sense to me, given the context of what we've seen in April. So that's why I haven't really been saying, oh yeah, short into all of this stuff necessarily, unless if it's like some intraday trades, like kind of what I do. But I still don't think that the market top is in right now, right? Like I could be wrong, but it just doesn't feel like a market top at this particular point in time because the selling is not like that intensified. So there's nothing crazy going on at this particular point in time. So like I said, we got to continue to monitor it. And then let's just touch on bonds and yields and we'll get into the conclusion section. Bonds, just relatively kind of rolling themselves over here, right? These are the nominal yields, the 10 and then the 30 right here. Just kind of paused, period of consolidation. So nothing too much to report here right at this particular point in time. The TLH has been finding strength right around this level. We did call out this positive divergence, and it made sense to see these kind of float around this area or bounce up and recover a little bit from this extreme sell-off here in recent months. So we got to continue to monitor these. Like I said, if you haven't watched my video on gold where I talk about both the nominal and the real yields and then the rate of inflation and kind of how, my views on it, go and watch that video so you get a better understanding of kind of where my head is at. Now let's just go hop into the conclusion, and then we'll talk about my kind of trade idea that I'm keeping an eye on, other than just XLE and the semiconductors that I've talked about already. But just so you know, to wrap everything up, there's not a really good signal as of right now, right? The bears are in this very short-term control because they regain control of the 5 EMA. That can change on a dime, all right? So given the current context overall of the environment is very bullish. So my kind of eyes right now are like, okay, I think that we're going to be seeing this pullback. I think selling can continue, but I don't think that it's going to be that dramatic. Okay, so 3 to 4% pullback in the S&P 500. We find our legs, find support, and then we continue to ramp up higher. That's a very strong possibility. So I'm positioning myself to take advantage of that if I'm right. I could be wrong, but if I'm wrong, it's not like I'm losing money. And if I'm right, it has a lot of reward to the upside. Okay, so one of the trades that I'm looking at here is WDC. This is Western Digital. Okay, it's a tech stock. It's just been on this red rampant blood, just spill out right here, okay? From 74.66, now it's had multiple red days in a row pulling into the 50-day moving average. So this to me, and it's upsloping by the way, okay? So we have a bullish trend and we're just seeing a sell-off take place in bullish context. My idea here is to see kind of what takes place these next couple of days and potentially enter in this orange box here and probably attack it kind of aggressively and protect the position with protective puts. Meaning that if I buy 100 shares, I might buy one put contract, at a strike price of $67 or something like that. I haven't fully decided yet, and I have to look at the cost of what it costs to protect this position. Then the red line here, right at around 71.80, that would be my first target. And then a full measured move would bring us into this green box right over here. So this to me is very possible if I am correct about the market pulling back, right, taking a little bit of breather, and then we see that move to the upside. That to me makes sense. So I would probably look at a strike probably about 2 weeks to a month out as far as protective puts go, because I do think maybe they're more selling to come. But if I am correct about the move to the upside, that would give us enough time to protect the position and then see it move to the upside. So that's kind of what I'm thinking here on this specific trade. But like I said, you got to be very, careful with what you risk. This is a higher beta stock, right? From 74 down to where it's at 67. That's a lot of dollar per share move. So if you're buying in a pretty large position, just know that it's easy to lose money, and there's nothing holding this back from just gapping down significantly and then getting stopped out at a lower level. That's why I'm planning on using protective puts. All right, everybody, that's all I got for you on today's episode. Hope you